A very good evening to all our valued guests. And thank you very much for joining us here today in our market outlook, redefining opportunities and uncertainties in China. I'm Jeff, the investment specialist for Affin Bank, and also your moderator for today. Now, today's topic is about China. As we know, China has been starting to correct since last year with a series of regulatory and policy changes from education to technology and then to properties. Just as we thought that market is going to rebound this year, there's another series of COVID-19 lockdown and also not forgetting all those global noises. All right. Today, we are just in time to actually have this webinar as we are approaching the year end of 2022, and in line with what China government is actually having, which is the National Congress this weekend. All right. Now, before we start, allow me to make an introduction to our speaker today. We are glad to have Ms. Penny Leong, the Vice President of Retail Distribution for Southeast Asia. Ms. Penny joined Allianz Global in 2018 in retail sales team in Singapore. Prior to this company, Penny was the head of distribution in Amundi, Malaysia. She was also the head of IUTA in M Fund Management. Penny has 15 years of retail sales and market experience, and she was also a graduate from Curtin University of Technology, Perth, with a bachelor degrees of commerce. So without further ado, I pass to you, Penny, and let us together redefine the market moving forward for China. Over to you, Penny.
Thank you.
Thank you,
Chef. Okay. Just can you see my slide?
Yep.
Okay. Good evening, everyone. Thank you so much for having me today. I'm actually, I think I'm honored to also share with you on the China market outlook. I'm not sure whether it's good timing in the sense that definitely a lot of investors will have a lot of questions, right? I'm here to answer your question to the best ability I can on what's happening in China. Now, I think it's good to let's put everything into perspective, redefining the opportunity, and also there's uncertainty in China itself. Now, what we're going to look at today is also how also what's the future of investing in China. Now, a lot of things have happened over the past 2 years now. So if you are a positive investor, if you look at it on the flip side, you would think that maybe it's a good opportunity to start investing in China. Now, of course, there are customers who look at it on the other side. After 2 years of downtrend, China has been down for 2 years. Does that mean that the growth in China is over and the so-called the opportunities in China is over? So these are the two things, two sides I will put into a coin that we should look at it. First thing is, of course, on the negative side, you will think that after 2 years of downturn or a correction, maybe that's the end of the story for China growth story. Of course, if you are a positive and you look at it on the positive side, is this a good entry point? Now, I'm going to recap the China market and also the outlook. So in this chart, there are three colors chart, blue, green, and also so-called yellow. Now, everything is very simple. The blue line is the China A onshore, the green line is China offshore, and then the so-called the orange yellow line is actually the ADR itself. Now, if you see the green and orange line has already been coming down since last year, 2021, and China A, the blue line, was quite steady until you see about beginning of this year, and definitely they all went to the same direction come May, June, July, or April, around that. Now, what has happened? To put everything into perspective is the correction in the offshore market and ADRs is also happened earlier compared to the onshore market, is because the offshore is on the crackdown of the internet sector, okay, and also on the education sector wise. So mainly they are mostly listed on offshore. ADRs is also the uncertainty of the delisting of ADRs, and also so that correction actually happened earlier. But of course, things were really brewing on the onshore, where people were talking about the property sector, and of course the so-called the zero COVID policy, and again the geopolitical risk on China as a whole. Now, these three things, I would think that is quite a main factor of what's happening to the market right now, where there are momentum. If you look at it, the main thing is these three factors or these three risks are actually affecting the sentiment overall in the China market. I'll try to explain it one by one on the three sector. Of course, as Jeff has rightly pointed out, the next meeting, the next key date we are looking at is the Congress Party, which is happening on 16th of October. Now, it's not a one-day event. It's going to happen on for a whole week. And then actually there are two parts to it. First part is on October, and the final part will be in March 2023, where then you will have a deciding factor on the leaders who are in the leaders in the key personnel in that. So there are two factors to it. Now, is it going to be a game changer? Everybody's asking, is this Congress Party going to be a game changer to the market? And is it going to immediately bounce up? Now, I'll put everything into perspective. I will answer your question at the end, whether it's going to be a game changer and what is actually affecting the China market and how it can improve and what the government has been doing already. They have already been doing something. They're not sitting there not doing anything. Yeah. So the main thing, first thing is we want to understand what's happening into the China market. First thing first, if you look at the what you're looking at, the property sector. Now, the property sector has come into limelight, I think, ever since last year. People have been talking about it. Of course, the main thing then become this year, and it's like over. I mean, people are talking about it, like a lot of people are talking about the property sector. Now, first thing first, property sector or property has actually driven China's growth for many years already. And of course, main thing is of the deleveraging. Now, a lot of all this word deleveraging, they have been trying to deleverage the property sector in China itself. Now, because as you know, the main thing is property developer has always been talking about all this. They have been lending, borrowing, and leverage. And also a lot of those middle class or Chinese are unable to buy property because the property prices have been so hot. So they're trying to cool down that kind of sector in that sense. Now, second thing is, of course, the zero COVID cases. Now, remember I told you three things. There were just geopolitical risk, property, and also zero COVID policy. Now, on the geopolitical front, I'm not going to delve into it because I don't think, and I think China couldn't and wouldn't do something right now on the geopolitical risk itself. Now, but of course, the property one, we have already seen a lot of implementation of policies into it. And then now the zero COVID policy, which I also will explain what we think is going to happen in the zero COVID policy. Now, for these two, the two main thing is property and zero COVID policy is really dampening the sentiment of the investors right now because people do not know what's going to happen and all. Now, because of this, before this, they were tightening in terms of financial requirement and domestically and all to domestic developer. So, but after that, where the so-called the policymaker sees that, you know, a number of developers actually having problem in terms of their cash flow, getting into trouble and all those, especially those non-state-owned developer, and also with the weaker GDP number this year, what they have been doing, there have already been some relaxation in the property sector, and all this policy are targeted a bit more into the property sector, where we have seen a relaxation in mortgage loan, okay, and also purchase restriction and also price control. Now, are they going to inflate the whole property sector again to make it hot again? Of course not. But what I think is they're trying to restore the confidence of the home buyers and also to provide stability in the market itself. Now, next is the second thing is the zero COVID policy. Now, a lot of people has been asking us, are they going to remove the zero COVID policy now? Now, we all understand this are the number of daily cases in mainland China during the COVID time, right? Why is that the lockdown in Shanghai is because of this number? Of course, the numbers have come down. There will be spikes here and there in terms of the numbers, but we think that they're trying to really to avoid an extreme lockdown like what we saw in March, April in Shanghai. Now, the property sector, they have really pushed in policy to actually cushion the downside risk. Now, it's not, in our opinion, we don't think it's going to be a systemic risk on its side and it's going to blow out. We think that with that policy, they are actually trying to cushion the fall itself and all. And also they don't want it to go into a systemic risk as banking or housing kind of sector. So that's why we think, in short, if property sector stabilize, consumer and business activity resume, then it will be quite positive to the market itself. Because it's already a bearish sentiment. Now, on the zero COVID policy, may I share with you? Now, there is some kind of relaxation already. They are trying to fine tune that zero COVID policy. Are they going to remove it at the moment? No. But really, they're fine tuning it. First thing first, in Hong Kong, we have already seen that you don't need hotel quarantine if you travel overseas. You just go back to Hong Kong and you're unable to visit crowded places like restaurants, gyms, and also maybe 3 days. Then once everything is okay, you do your testing, then that's fine. So compared to last time, it's 7 days hotel, then 4 days hotel, then 3 days you can't go to gym and all. But of course, we also see in China, there are some provinces, the Guangdong province, they're trying to open up already. There is a bit of travel into Macau and all this. So we think that's trying to fine tune that kind of restriction. But are they going to remove immediately the zero COVID policy in the short term? No. But really, if you look at it, China, like the rest of the world, in a way, will have to live with COVID. But the timing is an issue, or it's who can actually put down and say when is the timing. That is something that we cannot pinpoint, right? So we think that, going forward, there could be some relaxation, and hopefully there will be a bit more of the travel resuming in China itself. So as I mentioned just now, we are already seeing some provinces are opening up to maybe travel to Macau and all. So now, first thing first is also what we have seen in the past past 1 year plus is a lot of sector rotation in the retail investor. Now, China A market is about 70% dominated by retail investors. So all these retail investors is mainly really, they are very sentiment driven. If you look at this chart here, very colorful chart, right? Very simple to read it. Green is good, like your traffic light. Red is no good. Yellow and orange is just get ready to move and it's not too bad. Now, if you see, this is to show you a sector rotation, which is very, very quick. This is only yearly. I didn't even break it down into monthly and all those, right? Now, there's a dispersion in terms of the sector performance. Now, example is the only one I think did very well last 2 years is energy sector. And you look before that, it wasn't like one of the top performing sector, but 2021 and 2022, energy is the best performing sector. If you look at globally, I can also assure you that energy is still the best performing sector is a global global market. So who will have energy funds or energy sector as the only investment for last year and this year? A lot of investors won't have. So away and somewhat because of China A that is mainly dominated by retail investors, this sector rotation is very, very strong, as in you can have one of the best sector performance like IT. 2021 was still okay, green, right? Eventually 2022 is already down 31%. So what we are trying to maneuver here is in a market that is highly dominated by retail investors itself. Now, of course, we cannot go around not talking about valuation. Now, with the recent correction of the 2 years down trend already in the China market, I show you the China and also offshore, just to give you a picture of it. Like if you look at onshore market itself, it has come to all this valuation, even offshore market has come to their long-term low already. If you're looking at PE of onshore, it's about 13 times. Offshore is about 11 times. What I'm trying to tell you here is they have gone below their long-term average. An example, what I'm trying to say here is the market is, I would say it's very, very, very cheap. It's quite cheap already due to the sentiment, the bearish sentiment, and what's going on in China right now. So is it going to be a good investment or a entry point? Let's share with you the next one. Now, China A has a very, very low correlation with a lot of global market, US, European, and world equity. When it's green, that means they have low correlation. When it's red, of course, high correlation. Now, what I'm trying to say is investors can look into adding China A as a diversification into their portfolio itself. Now, of course, this year is very, very special. Anything you buy is just on a downtrend now. But I think China is moving in a very different direction compared to the US and also global economy-wise. If you look at it, US is all increasing interest rate, whereas China is on the other end, is cutting interest rate and actually being more supportive in their policy. So I think this year is very unique year. Each country, each major market have their own problem in US, it's going to be inflation, rapid rate hike. In Europe, the energy crisis, the inflation also. But in China, that's going to be zero COVID policy, the property sector, a bit of geopolitical, and they are actually easing in terms of their policy to support the growth of the market. So what I'm trying to say here is China, in a way, because of the low correlation with the other markets, it's not a bad idea to actually add on to customers' portfolio or your portfolio to actually look into a diversification play into the portfolio. Now, next thing is, of course, what I'm trying to say here is investing in China comes with a different set of risks compared to US and Europe. If you look at this chart in green, this roller coaster ride is actually, I would agree and I would understand it's quite scary for investors now. But China is a different set of risk and return compared to Europe and US. Now, if you look at it longer term, the return is not that bad compared to US and Europe. But of course, you come with this kind of roller coaster ride. So investors investing into China need to understand that this kind of risk is only quite special to China itself, very, very different. But overall, if you take a longer term kind of view, it's not that bad in terms of return wise. And of course, with the low correlation to the other major market, it's not a bad investment idea or portfolio to have in your portfolio itself. So, but bear in mind, this kind of volatility that will definitely be in investing in China. And with the two main things that I shared with you, the property and the zero COVID policy, we will see short-term wise, the market will still have a bit of volatility. And what's going to happen in these two themes will actually also in a way define the market position going forward in a direction in the next few months. Of course, these are okay, we will have to actually go through it. Now, if you look at it, then what is the implication of China futures growth model? What is the growth model of China going forward? Now, there are three major areas. First thing is, I'll share with you later, but these are also tie in with what we see in the growth area in this 1, 2, 3, 4, 5 area, but it comes to three major areas. Now, of course, self-sufficiency, strategic area like semiconductors and all. This also come from the uncertainty in terms of geopolitical risks, where you will have a lot of trade restriction. Renewable energy also, I'll share a bit more in detail later, renewable energy. And you know that China is going for peak carbon emission by 2030. And also they are going to look into the net zero emission in 2060. So a lot of things are happening in the green energy, clean energy space already. And then opening up with healthy lifestyle. Of course, as I said just now, they are fine-tuning in a way their zero COVID policy, but are they going to remove it immediately? As I shared with you, they're not going to remove it immediately. But really, we think that China will just be like the rest of the world live with COVID, but when that is the $1 million question, when, right? So, and infrastructure stimulus, as you can see, what they're doing now to spur growth or to actually support growth is also through infrastructure stimulus to those very targeted area like infrastructure and all. And there would be a bit of financial market reform, liberalization that we think that will be also going forward, another theme investing in China. Now, as I also share with you now, we are just going to share with you some areas. I'm not in a position to tell you whether China will achieve it, when they're going to achieve it, but let's look at it in a way. Now, China, the three major areas, future growth of China, one of them is innovation. Now, China has realized that the need to aim for a more diverse growth, because property has actually fueled the growth of China for many years. Now they need to look beyond property. What are other areas that actually can help to sustain that kind of growth? We are looking for more sustainable kind of growth, right? So main thing is, if you look at it, I'm not sure whether you know that actually China is the largest market for EV globally. I didn't really know. I know they are big, but I didn't know that they're so big. Over 40% of global sales already. And also they are they are leader in renewables with more than 70% global output across solar production. And they are into 5G network. By 2025, there will be 3.6 million base stations. And they have already taken a step ahead into developing 6G. So, and there are a lot of new drugs under development, and they are actually the world's largest market for industrial robots. Now, China is very into R&D over the past 20 years already, and they actually account for a lot of other things, patent, all these things, trademark applications, which I'll share with you later. Now, main thing is what investors need to understand, and what other thing that we think is also China. You need to rethink this model. China is no longer the low cost, the lower end manufacturing country that we used to see maybe 10 years ago. Remember last time, 10 years ago, like your clothes from Nike and all those, all made in China and all those, because it's cheap and labor is cheap. Now we have to rethink this already, because for the past over 20 years, they have spent a lot into R&D. Now, another subtle change is also into the innovation. Now, in a way, we live in a new world that we have to understand that there could be a emergence of two tech superpower, right? The US, the West, and also in China itself. Now, this is something that we need to understand, and you know that the patent and trademark filing from China has actually outpaced North America. Over the past 20 years, they have spent a lot on R&D, and all this patent and all that, they are just second behind US. What we're trying to tell you, the patent and trademark applications, China is accounting for about, you see, trademarks, 54% already share of the total world. So for the past 20 years, they have actually moved very, very fast. No more the low-end manufacturing that they used to be. They are more into innovation. As I said, they have to look into area where they have looked in, they need to have more sustainable growth, and no longer just the property sector itself. Another subtle change is also within innovation. This is a shift, innovation focus from consumer tech to hardware and industrial tech, with like the development and design of semiconductors. That is also a part of result of external uncertainty and trade restriction. That also ties in with the self-sufficiency theme. Now, over the past 10 years, they have been very fast progress. Consumer tech, like instant messaging, short video, your content, or your online shopping and all those kind of things. This has actually been very fast for the past 10 years growing, right? Now everyone knows how to shop online. 10 years ago, maybe we don't even know how to shop online. But of course, with COVID, everybody from 5 years old to 85 years old, so you know how to do shopping online, because you got no choice during COVID. That is also, that has propelled that to be at the forefront. Now, what we are seeing in China is the policy. We are seeing fast seeing the policy shift from this consumer tech to the tech hardware industrial tech, where they have development of semiconductor. Also, this trend, let's look at this chart here, the blue line and the orange line. Now, this trend also reflected in the share prices. If you look into the line itself, the blue line represents the semiconductor equipment index. The orange line, so-called, or yellow line, it is something like the internet companies. Now, if you see, they has already outperformed the semiconductor equipment companies have already outperformed those consumer kind of tech companies, you know, as in the really past few years, and also especially in the mid of 2021 with because of the crackdown and all. So we think that with more time, effort, and also capital invested into this area on the semiconductor space, or they call it the tech hardware industrial tech, that will maybe continue. This trend will maybe continue forward. So that's why subtly in the innovation tech space, we also see from consumer tech moving into the tech hardware and also industrial tech itself. And also you have seen that in the share prices of that. So this is subtly what we have seen in the innovation space. Next one, of course, is the green energy. Again, it ties up with the renewable energy, which I shared with you, the theme, one of the 5 themes that we are looking to. Now, green renewable tech, partially because of environmental reason. Everybody is going for environmental reason. You talk to anyone in this world, I mean, every country is talking about environmental change and climate change and all this now. Also potentially for energy security reason. Now, you know that now Europe is also in a not very stable, not to say very stable, they're unsure what's going to happen in winter, you know, with the energy supply coming from Russia and all. So China has a long-term policy objective to diversify their power generation. So on the chart on the left, you see that all these solar, hydro, all these things combined over the past 10 to 20 years, renewable energy, like I said, wind, solar, and all those actually account for majority of their power generation. So there is a shift already in the past 10 to 20 years where they move from the very traditional coal, natural gas, nuclear. They have already shifted to wind, solar, hydro slowly, and I think this will continue in that sense, because remember the 2030 peak, 2060 zero carbon emission. So all this slowly will have to shift in that sense, and you already seen it for the past 10 to 20 years that shift is happening already. So China also invests in the so-called major ultra high voltage grid lines. You can see here, right? And they have actually all this, what is happening is those like power store equipment, because a lot of these renewable energy generations are now done in the western side, Xinjiang, the western side of China. They have to move it to the coastal side here, which you see the arrow on the red, right? All these grid lines and all those, they have to move it because there is this is where the consumption are, and also is at the coastal area itself. So in A-shares, we actually have identified a lot of companies, you know, involved in this manufacturing of power grid equipment, power grid storage, which will then benefit from this trend that is happening. So this is what's happening because of the investment into this ultra high voltage grid line, where they are moving from the west to the coastal area, and also to where the consumption part, you see like Shandong, Jiangsu, Shanghai, all those, these are where the consumption of the renewable energies are. So that's what we are seeing in the renewable energy space, and also that ties up with self-sufficiency and renewable energy. Next one is also healthcare expenditure, actually 398 million. They are an aging population. By 2060, there will be about 400 million of Chinese, which will be 65 years and above. That account for nearly 30% of Chinese population. And over 180 million elderly are suffering from chronic diseases. And China is actually the highest in the world in terms of adult diabetes in itself. So you know all these things, that means in a way their healthcare system needs to be better. And now the waiting time in China is very, very long in terms of consulting hospital doctors and all those. So, but the healthcare expenditure in China, if you look at this chart here, it's quite low compared to the developed world like EU, Japan, and US. What this means that the expenditure, the spending expenditure will only go up in the future due to all this that we are seeing, the aging population, the chronic diseases. They are really number one in terms of diabetes. I mean, for the wrong reason, diabetes and all those. So these are things to show that they are going to be more spending into healthcare. And we think that, you know, going forward is also a trend that it will go upward in that sense. And also I'll share with you next slide in terms of what terms in on the healthcare side itself. Yeah. Do you know that actually China is a global leader in some key areas such as oncology, and is also a leader in oncology drug trials, and globally they are already accounting for about what 40% of it. So why? These are structural driver because there is actually strong demand from patients. Okay, and also there are more R&D and tech putting into it. Okay, if you look at the new drugs development, it has actually tripled in the last 5 years in China. So these are what you're seeing in terms of in terms of healthcare spending, and also to just share a thought with you that they are fast-paced in terms of drug development and what they have been doing. You know, they could be, as I said, we expect them to be a global leader already in key areas such as oncology, because many of those drugs are coming out from China itself and all. So next one is also skincare, willingness to, we call it pay for health kind of theme. Now that's also thanks to the rising household income. We observe this trend is called pay for health, right? So if you look at eye care, China in terms of eye care penetration, surgery, all those, compared to US and Japan, there is room to grow. And skincare, also, they are spending a bit more on consumption of skincare. I'm not sure. As a lady, now only I realize that you have to put a lot of things, a lot of skincare on your face just to make sure that you look good on camera. So that's one thing that we have been putting, and all that's something I learned. I mean, if you look at Korea and all consumption in skincare, if you go to Korea, anytime you walk around Myeongdong, you see all these are selling skincare now. China is also up and coming in that sense in terms of consumption. Now, sportswear also, I'm sure that you can name me one or two brands from China, the sportswear itself. Now, what interesting observation is what we are observing is we are seeing the fast market share gained by domestic brand. Actually, the top three brand account for about one quarter of the market already in China, and also they are gaining market shares and winning market shares from their all those international brand. Like I am sure you know Leong, the brand, right? That's one of the top that you can name me. I actually recently learned about a brand called Anta, also from China itself. And as a consumer, to be very frank, last time when you tell me about China brand, like your aircon and all, I am a little bit skeptical 10 years ago, but I'm proud now to say that I am more open, being more educated in terms of what's happening in China, and definitely you see the change. I want to tell you, I have two things that are from China right now, which last time I will never buy. First is I have an air conditioner from China, it's media brand. And recently I bought a sports shoe from Anta. And I find it's cheaper than your usual brand. But of course, I think in terms of looks and all those, it's not bad. So that's also, you see, overall, as a consumer, I am also changing in terms of my appetite and being more receptive to those China brand. And I think they are really gaining market share, not only in their domestic market, but also I think globally, slowly, they will. Ask yourself, would you be willing to buy? How many of you have a Huawei or Oppo or all this China brand phone? If I asked you 10 years ago, you can only tell me Nokia, Motorola. But now if I tell you, Huawei could be one of the first that comes out, and then Oppo and all this Xiaomi and all. I also have a Xiaomi portable fan, USB to charge. So these are also showing you that how receptive consumers are to the China brand compared to 10 years ago. So all in all, I would just to conclude in these three pointers, really macro weakness definitely weighing on the sentiment, further policy support, and also undemanding valuation. Now I've shared with you the valuation on China onshore and also offshore. I think that is something that is also attractive at the moment in terms of valuation, and hopefully that would restore a bit of confidence as we move into the year end and into 2023. Now, definitely to achieve a long-term growth and sustainable growth, China is changing in terms of their economic model, where they will be based on technological advances and innovation, which we have already seen happening for the past 10 years as consumer. No longer we talk about garments, cheap, lower end, all those being manufactured in China. They are talking about those innovative products that's coming out from China itself. We are definitely seeing significant long-term opportunity in a wide range of areas like EVs, software, green tech, autonomous driving, semiconductors, and even healthcare, as I've shared with you in the last few slides. So I do understand the volatility in the market. It can make us very uncomfortable. I mean, if you have the really the so-called the hindsight, if you look at the chart, maybe this is the best time to invest. I wouldn't know, but I hope that I've given you a bit more clearer picture of what's happening in China and some ideas where China is heading into in terms of their growth model. Pass it back over to Jeff.
Thank you very much, Penny, for the insightful sharing. All right. So now we will be going into Q&A question. All right. So for all value guests, feel free to actually post your question into the chat box. We will try our best to actually attend all the questions asked. While waiting for the question to be posted, Penny, let us discuss on some of the common inquiries that we have from the customer lately. All right. Now, question number one is a little bit related to the COVID-19 lockdown. All right. To tilt the question a little bit, many attribute the recent lockdown towards the National Congress. All right. So my question is, will you be seeing any chances of easing off after this National Congress on the 16th?
Okay. Sorry. Do you see the question now?
No. Yes.
Okay. You see here, right?
Yep.
Now, there definitely I think they are not going to ease before the lockdown itself, right? As I said, not immediately. So definitely the much awaited China reopening is only a matter of time. Okay. The ongoing ad hoc lockdown and frequent testing are unsustainable for growth and also stability. So for us, it's really to give you a glimpse is Hong Kong already, so-called, they have removed the hotel quarantine. That's something that we are seeing. And also an interesting recent event that we have picked up the fact that a sporting event recently with a capacity of more than about 30,000 spectators is taking place for the first time since 2019. And also combined with resumption of package tours from mainland China to Macau. These are all small steps in the right direction. So okay, and also there is so-called a return of the so-called 7 rugby, if you're into rugby, 4 to 6. But all these things that we are seeing slowly, they're taking steps to reopening. But before the so-called Congress Party, I think it's unlikely before that. But we think they're heading into a direction slowly with all this and using Hong Kong as a proxy to that. I hope that answers your question, Jeff.
Yes, thank you, Penny. Maybe we can move to the second question. So second question is about the National Congress that we have. We are going to have this weekend, all right? So my question is, what do you see some of the outcome that is that we can expect from the upcoming National Congress? Maybe from a leadership perspective, is it presidency is going to continue his new term? And also, if the answer is yes, what are some of the policy implementation changes in that sense? Yep.
Okay. I think presidency being re-elected, I guess there's no one who will say no to it, right? I think majority of the market consensus is he will be re-elected, correct? So that would be, I think everybody's heading to that direction. Now, what is going to be the implementation? First thing first, I want to put is Party Congress. Our view is the Party Congress is not going to be an immediate game changer. Okay, we do not expect to hear new policy stimulus measure or changes to COVID policy over the next week, for example. And you must understand the Party Congress is not a policy making body. It sets the overall guideline for politics, the economy, and foreign policy itself. So now, of course, so something to watch for during the Congress are signs to move away from this de-risking theme and more emphasis on growth and development. So we believe economic growth continues to be the top priority for China's leader, not least because the importance of economic growth for social stability. So while any change on a broad emphasis may not lead to an immediate market rally, so just also to put in an important signal that this is where we can expect to see the focus of policy in the coming years. And in turn, this should start in time to rebuild confidence, both domestically and also foreign investment community. So over towards the year end, it is also an important event. I also have to put it to you is there is an economic outlook, which is the annual Central Economic Work Conference. Now, it is this a conference which will set the national economic agenda and also should give us a better steer on the direction of economic policy, as well as a sense of coming year's growth expectation. And then in March 2023, we will then hear the official growth target for the year at the National Party Congress. So National Party Congress is now and also in March. But in between year end, there is a Central Economic Work Conference, which is also something that you want to look out for, where they will set the national economic agenda itself. So I hope that answers your question.
Yes, thank you, Penny. Talking in terms of regulation and policy, with all these years coming in, they are actually striving for stable growth. But as we see, there is a lot of lockdown, prolonged lockdown, and all these regulation risks and also noises still remain. So what are some of the upside potential and also headwind left for Chinese investment moving forward?
Okay, the headwind of the biggest unknown is definitely the COVID relaxation policy. But I've answered in the previous question is also we are seeing some steps towards it already. Now, I think, yes, the tightening regulation policies over the last 1-2 years, especially on the tech wise and all those, right? Already, I think the tech, all those we have already, it has already been played down a lot already. And you've seen some even relaxation in terms of those sectors. So the upside potential is really, we look at what I've shared with you, the theme, innovation and all that going forward into China's growth. That would be that. All these policies and all will be a very short-term noise. And the zero COVID policy, as I say, one thing, main thing now is a COVID relaxation policy, but we are already seeing how they fine tune it and taking baby steps towards relaxing that also. So if you look into the longer term, I think investors should really look into the longer term itself and look at what are the themes that I have shared with you just now on the China future growth model.
Penny, believe that you shared with us about the property sector that it is not something like a systemic risk. All right. So from this perspective, do you see any revival in near term from the property space?
Okay. Revival is what the government is trying to do is just do enough to actually commission a downside risk. That means they want to actually handle the downside risk or cushion the downside risk. They are not going to heat it up again. I don't think what they're going to do is heat up the property sector again. They want to cushion this fall to manage that kind of downside risk. That's why we think it's not going to be a systemic risk. Of course, because they are looking into a more diverse growth area, like into innovation and all those for China. Property sector has already fueled China's growth for many years already. I think it's time to move on to a more diverse growth model and not just only on property. So what they're going to do now, or what they have been doing, like relaxation in terms of the mortgage loan, price control and all those, is not to heat up again, but to actually restore confidence and to manage that downside risk.
Maybe for the next question is pertaining the prolonged COVID-19 lockdown and the slowdown in terms of the economic activity. In fact, we see some of the research house starting to downgrade the GDP for next year. All right. So with this prolonged disturbance and also noises still ongoing, what are the possible measures that you think the Chinese government will do to recover the investor confidence in the Chinese market space?
Actually, the government has already started work. Let me go to some of the measures, right? They have already started putting out all this measure. There have been announcements across a range of area, including new infrastructure spending, tax break for businesses, incentive for car sales, easing of loan terms, cut in mortgage interest rate, and and instruction for banks to increase lending already, which we have seen coming into until July this year. So you see, example, April reserve RRR ratio was cut 25 bips, and January and August there was again interest rate cut into the loan prime rate by 15 bips, and July there was announced the setup of another renminbi 500 billion infrastructure investment fund. All these things have already been in place, and there was a tax cut renminbi of 1.3 trillion in April, May that time. And also extremely rapid issuance of local government special bond in Q2, Q3 to support infrastructure spending. Now, all this has already come in place for the market itself. And all what we believe the future measures will primarily be in terms of higher fiscal spending, especially to support infrastructure. And also in a way, we do expect more measure to increase confidence in the property market, which I also recently I told you, like the mortgage loan, cut the price control and all. And also the special infrastructure bond, which was done in July 2022. So all these have already come in place. But of course, then the next question I would envisage you will have is, how come the market sentiment is still weak and it doesn't seem to like the policymaker, and then the market will react? Now, the main thing is also is because of the zero COVID policy lockdown. I mean, the zero COVID policy in China itself. That has really dampened in a way the sentiment of consumer spending. Consumer are not really spending wise, and they cannot travel and all this domestic consumption. So that's why this is one of the things that is also dampening the confidence or consumers' confidence of the market itself. That's why, and also all this policy, right? When policy changes and all that to go into to actually be translated into the market, it takes some time. There's a lag time of about 7 months or so. But why is it so long this time? Is again the zero COVID policy of China. So that's why if hindsight, and if that one is removed, I would think that market will react quite positively to that if the zero COVID policy is actually removed entirely in China. But again, as I already said, because they are already taking small steps to fine tune it and to relax it bit by bit.
Yes, Penny, you have actually answered my question, because in fact, I have another question to ask about the interest rate cut. Why is it there is not much of a revival effect after all these rate cuts?
It's really sentiment. Right? Yeah, it's really the sentiment.
Understand. Yeah. So last question before we end this session, which is crystal ball question. Perhaps you might want to recap a little bit on the whole China market. as we move towards the end of the year and also for the year in 2023. So what is your view for China market moving forward?
Like you say, it's a crystal ball question. I would say it's $1 million question. Now, we just put everything into perspective again. I really don't have a firm, quite 100% answer for you. Now, China, like any other market, is actually down about 29% this year. If you look at globally, global markets are down about 25% or so. So China is not very far away from the global markets. It's not like the global market is up, China is the only one that's down, right? So to be very fair, China is quite in line with the global market in terms of this year's performance. Now, again, two main concerns at the moment. Again, geopolitical risk, as I said, I don't think China's going to do much about it. So the two main one is really property and also zero COVID policy. Now, again, I've shared the property sector-wise, we think the base case is they want to avoid the worst case scenario. They have done what they could to actually cushion that kind of downside risk. And our base case scenario, it shouldn't be a systemic risk itself. Now, moving to the zero COVID policy, despite the whole world is reopening. Like I just came back from Australia recently. I actually forgot how to wear a mask because people don't wear masks there in Australia. In a lot of other countries, if you have gone to UK and all, nobody wears a mask, right? But China, imagine you still have to come back to have quarantine, you have to have lockdown and all. Now, really the market actually expect China to abandon or relax their zero COVID policy post National Congress Party, right? So again, I don't have a clear crystal answer to that, whether they're going to remove immediately, but we are seeing they are slowly relaxing and fine-tuning that already. So if all these two main things is really being removed and can tackle it properly, I think then the confidence will actually come back to the market itself, you know. So that's why what we think is really our base case scenario is China will be able to actually stage maybe an economic recovery heading into year end and also into next year. But the path of recovery may not be a smooth one. It's not a one-way ticket up. It's going to be a bit, it will be a bit more volatile and a bit more patchy. But the thing is, again, I would like to reiterate, we need to look at China in the longer term. And if you believe what I've shared with you just now on the theme and on the future economic growth model of China, we just got to bear with all these noises and look into the longer term of investing in China. So that's a takeaway that I have to share with your clients today. Really, I would love to be able to give you a very straight answer, yes, no, confirm, but really we are in very uncertain times, and I do hope that customer will be a bit more patient. And definitely, if you really look into a longer term in China investment, and you do believe in investing in China with the future growth model, innovation, technology-wise and all those, then we have to relook, is it a good time to enter now with all these noises at the moment? So that's really what I have to share with you and your clients today, Jeff.
All right, thank you very much, Penny, for all the insightful sharing and all the knowledge shared. All right, I hope that with this, all of us may get some clarity in terms of the journey, the investment journey moving forward and next year. All right. So if let's say there's a one word that I can conclude for this session for China market, it is look beyond the potential. Yeah. So to our value guests, we are aware that market is very volatile. Agree to that, acknowledge that. I cannot guarantee whether it will go down further, but what we can guarantee is if you are actually entering now, you are actually entering at a discounted pricing of about 30%. All right, 25 to 30% at least. Some even go to an extent of 40 to 50%. All right. So at this point, sometimes while we are actually looking very closely towards the market, this might be one of the time for you to actually put in some of the investment amount into your portfolio. All right, not all, but put in by batches. All right. So before we end the whole session, perhaps let me share with you some of the wealth solution that we are able to provide. This will be some of the campaign that we have here in Affin Bank. So in Affin Bank, we are not just providing you wealth and investment solution. We add flavor to it. So these are some of the campaign that we have on our shelf for this moment. Yeah. Next slide. All right. First, we have Affin 2022 Road to Qatar campaign. So this is more kind of like about the FIFA World Cup campaign, where by investing with us, by signing up account, credit cards, investment, banca and also deposit with us, you will get some entry and you stand a chance to actually win over a 200,000 of pricing, including a return ticket to Qatar to watch the FIFA World Cup final. All right. So this also includes some of the other free gift like the jersey from the football team. All right. Sony Bravia TV and also the Apple iPad Pro. All right. So this campaign actually expire by the end of 30th of November. All right. Next slide. Next, we have this campaign which we call Merdeka Bonanza. This is about investment with us at a certain sales charge pricing, and you stand a chance to actually get these exclusive offers with vouchers and also rewards. All right. And similarly, for the third campaign, which is the wealth deposit campaign. Yep, this is the wealth deposit campaign. We're aware that you might want to look into some of the deposit product that we have here. So with some investment in unit trust and also Amanah Saham, you can actually place your FD with a special rate of up to 16.38%. And last but not least, for our final campaign, which is the 1% birthday month campaign, as usual, I think some of the client has been using and utilizing this over the year. All right. If this is your birthday month, you will be getting the privilege of having a 1% sales charge when you're actually investing in the unit trust with us. All right. All in all, thank you very much for joining in this session, in this webinar. And if you have any queries or if you would like to explore further in terms of all these opportunities in investment, please contact our relationship manager and we will scout a portfolio that is specialized for you and your family. Thank you very much. And once again, thank you, Penny, for the meaningful and insightful session. And also, thank you very much, M-Invest, for the collaboration to make this webinar a fruitful session. Thank you very much, all. And may everyone stay safe. Thank you, Penny.
Thank you. Bye-bye.
Thank you. Bye.